Welcome back to Behavioral Finance and FinTech. I'm Andy Kim. Here we're going to talk about the short selling intensity in Korean market. And then recently the politicians like Hong Jun-pyo, and then those parliament guys, they're no matter how smart they used to be before becoming politicians, it doesn't matter, right? They all become stupid as they join the political arena. And then they try to ban the short selling once more in Korean market, and accusing that short sellers are illegal price manipulators, and then it's unfair that the institutions can easily short sell whereas the individuals cannot as much. The thing is, short selling quantity, right? How frequently are they done compared to our archenemy Japan, our rival that we perceive? You see this graph over here, only 8 versus 38.7, right? The short selling amount, right? Or the ratio. This is a percentage figure, by the way. or almost 40% of their shares are traded in the market, sold in the market, are short selling, Japan and US. In Korea, only 8% are short selling volume. Oh, Korea, we are still we are still in infant stage, enfant. And I'm saying, opportunistically we claim that we are, a small child. Opportunistically we claim that we are big guys somewhere. And we want to be big, and we want to compete against Japan in every aspect. Now, let's get mature over here, all right? So, but the politicians, they're trying to comfort all the general public all the time. You, we have to spoon feed you, and then, those bad short sellers, right? And those bad professors who say short selling is good. So that's the reality. Anyway, so we need to go farther, right? There's a long way to go. It's time that we should do courageously. Sampro TV, or just a lot of experts in the market, Sampro TV or Kimpro, right? They say South Korea has to get into the mature market index, and the MSCI index, right? Instead of staying in the emerging market index. But that does not happen for free. Everything has a price to pay, and this one is one of the significant price that we have to pay. And it's not that much, big pain for us. It's going to be painful for my kind of academicians who say that the short selling is beneficial for us. Okay. It's simply not as popular, right? But we have to go through this one. Anyway, arbitrageurs in practice, right? Realistically, arbitrageurs need to think about the following three, which is expected value of abnormal return. If the abnormal return or profit that you take is small, they would not even bother it, and then they would have to consider, the risk associated with their short positions, right? We're going to talk about what kind of risks are there, and then the time horizon of investment, right? If the time horizon is not long enough, they would not even bother go into that short selling. Okay, these could be constraint in executing short sales. Arbitrageurs, they are not volunteers, right? I should say this, right? They want to get paid, and risk have to be minimized anyway. Now, what is arbitrageurs and what limits arbitrage in place? And so those are the things that we're going to talk about here. What is an arbitrageur? This term is abused. In general, an arbitrageur is the one who knows the true value of your stock, and but may not be able to find a truly riskless trade. Proper arbitrage to enforce price equals true value. Textbook arbitrage, they say it's risk-free, but it's not. I know, we know that, right? But even with that, there is still a need for arbitrageurs and the short sellers' value. So they may pursue mere good bets as well as the true textbook arbitrage. Yeah. Now, textbook arbitrage is like a simultaneous purchase and sale of the same identical asset or essentially similar security in two different markets for advantageous different prices. So gold traded in, London versus 24K gold traded in London market versus Paris market. If there are different price for the same material, same asset, there's an arbitrage opportunity, which is extremely difficult to find these days anyway. And key features of textbook arbitrage is that number one, net outlay is zero. There's no cost, right? Because you're taking long short position. You take long position with what cash? Money. What money? The money that you got by short selling first. So short long position is like a short long. Short sell the stock and get the cash, and with that cash take a long position. That's zero net outlay investment. And then profits upfront. Why? Because you take the cash and then you, I'd say, sell high, buy low. So the same gold, short sell the ones that is highly priced, short sell it, get the cash, and then buy it in a lowly priced market. So you get the difference immediately. Lock in the profits upfront. Number three, no future obligation, no risk. At the end of the day, you have to sell the stock or asset that you longed, and then with that cash, buy back those shorted asset and then pay it back to the lenders, right? So no future obligations other than that. Slight deviation from the scenario makes arbitrage much more difficult. So let's see. Long short trades, recall our scenario 3 in our week 2 discussion. We had those arbitrageurs, right? Infinite ability, Avenger level arbitrageurs, right? Our most general defense of EMH was this one, and didn't require investors to be rational, and we didn't require irrational beliefs to cancel each other out, balancing each other out. But what we need was just the infinite capability of these arbitrageurs. And then now, long short trades, argument for the flat demand curve offered by Myron Scholes was like this: the shares of a firm sells are not unique works of art, but abstract rights to an uncertain income stream for which close counterparts exist, either directly or indirectly, via combinations of assets of various kinds. And the implication is that the risk of long-short arbitrage is low because correctly priced substitutes are available and can manage risk and then still get expected abnormal return. And then arbitrage would be easy in textbook-wise, right? Long side, yeah, and short side, you know that this is self-evident over there. As Scholes describe it, long-short arbitrage is easy and appealing, and then, the textbook life, laboratory life, easy. I know. Okay. Evidence that AD slopes down also happens. Aggregate demand curve of the security. We assumed it to be a flat curve, but the thing is, every now and then we find some evidence that it seems to slope down. Okay. Moves in stock prices that are hard to connect with news, right? All those things seem to suggest that the evidence of behavioral finance suggests that the demand curve is maybe not flat, but downward sloping. Okay? Media impact and all these kind of things. In practice, some problems with scenario number 3 is there. Real world arbitrage, right? I told you about these restrictions considered. Yeah. In general, arbitrage is less effective if arbitrage happens less when the expected return is small enough and the risk is high enough and trading horizon is very, very short. Then nobody will trade that and nobody will try to arbitrage it. That's too dangerous, right? And the biggest risk that the short sellers face we call it noise trader risk, noise trader. Interim price risk, we call it. If mispricing is driven by noise traders, and you may get worse, the mispricing may get worse before it gets better. The price gap, the gap between the price and the true value. Of course, the true value is not very visible, not observable. So how can you tell that it is really mispriced? But somehow, let's say, you can estimate that true price somehow. If it gets different a lot more, you have noise trader risk. And then the real risk if arbitrager has a short horizon. Okay, if your investment fund, right, hedge fund is like a monthly based ones or even shorter. Okay, you cannot take the short position and make money easily. No, arbitragers may have to bail out when mispricing is the greatest. Yeah, and so you will watch the movie The Big Short, and then you will see this kind of noise trader risk associated. They had to go through. Yeah, Michael Burry, right? Their stories. The example over here is UBID and then PC Mall. All right, what is that? Well, by the way, noise trade is noise is a kind of engineering term. A lot of the term that we use in finance come from engineering because we have so many engineers jumping in, right? Rocket scientists and competing with us. Anyway, signal to noise is an important concept. Signal, well, it comes from your signal processing in 전파공학, like kind of, 전기공학, electrical engineering, right? You send those signals, radio signals, and then you catch it, or television signals and catch it. And then signal carries those information about the person, like the actors working, like all these kind of things. That's a signal. And then those noise is the one that you send and receive, but it carries no information. You cannot see any faces over there, but white, black, blah, 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 in random fashion like this. That's what we call white noise. Okay. And then in terms of noise traders in the financial market, the picture that I have in my mind is small fish, big school of small fish. Okay? 정어리 떼들 kind of things, right? They are just swimming without anything in their mind, like blindly following this and following that, here and there. Arbitrageurs were rational investors, institutional investors, or 기관 외국인 kind of things, right? They are like a shark or big fish, okay? They are fast in tasting or smelling the blood in the sea, and then mercilessly they just take profit of it, right? By eating all this kind of small fish, right? But every now and then we see noise trader risk like this. That's the situation when the shark-like guys, institutions, imagine that they could eat this, take profit based on this small fish stupidity, but the stupidity is so huge in scale so that they cannot eat it. Instead, when their mouths could be split and torn apart, 아가리 찢어져 kind of situation, right? That's noise trader risk. What is that? Here's an example, okay? UBID and PC Mall. By the late 1990s, PC Mall was a successful catalog distributor of computers and computer peripherals, and publicly traded as Mall, PC Mall, and had opened several retail outlets. And in early 1998, that was a dot-com bubble period. Everything, dot-com company pops up, investors welcome, and then, oh, sexy .com, I'm going to buy that one. The demand is so high. PC Mall began selling computer equipment over the internet. Their one division found a smart way of making money. Oh, this, internet business seemed to be promising. And then the company developed the UBID website and spun off, basically. They were selling factory access refurbished goods through an auction format like eBay kind of things. And then eventually they spun off and IPO'd this UBID, their subsidiary company. Okay, so the parent company PC Mall, and then the subsidiary UBID, right? And the thing is, the parent company kept 80% of the ownership of this subsidiary, and 20%, only 20% was launched and floated in the open market as after the IPO. So theoretically, the value of the parent company PC Mall has to be bigger than the value of 80% of UBIT, the son company or subsidiary company or daughter company, what it may be, right? This inequality should happen, okay? But in reality, guess what happened? Market cap of the UBIT, right, the affiliate company, subsidiary company, was $327 million, whereas, and then the 80% of this was $262 million. And in contrast, the market cap of the parent company was much smaller than the 80% of the subsidiary company, $233 million, right? And you found the mispricing. Now, what's the situation like? It's like either the parent company is undervalued, or the son company or affiliated company or daughter company is deeply overvalued, okay? Or both. Now, what's your strategy? Jim Rogers' strategy: buy low, sell high. Buy anyone that is lowly priced, and then short sell anyone that is highly priced. All right? Take a long short position, okay? Short the son and long the parent, okay? Or the affiliate. I mean, sorry for the daughters, my two daughters, and then, no intention to gender discriminate or anything. Don't get pissed off. I'm sorry. Anyway, wait until the two prices converge, right? That's your long short strategy. But the question is like, but how long can you wait? Here's the thing that happened in 1998, right? This is the point where you found the discrepancy, those price. The red line is the PC Mall's share price, per share price. And blue line is the 80% value of the affiliate company that belongs to the parent company. So the blue line has to be below the red lines, but it was up higher than this, which is discrepancy and then the mispricing. So what do? You short sell the blue one and long position for the red one. Okay? Guess what happened over time? Oh my God. The mispricing gets widened like, so, and then it took more than 6 months for this mispricing gets corrected. That's the whole story over here. And the thing is, if you took a long short position over here, and your loss must have ballooned like crazy. And then the profit picture looks like this. The dollar amount of profit. Well, what profit are you talking about? In the middle, you must have made like huge loss, like $70 or more. And then returned it, and eventually in 6 months, you started to make money. Okay? Now, lucky you if your investors were patient enough to wait until this part, 6 months or something. What if your investor, your hedge fund manager, you are the hedge fund manager, and you're the people, the rich people who put their money to your fund. If that the original investor of your hedge fund, if they are impatient and they come back to you at this moment and say, you are stupid, and then we are all screwed, I want my money back. At this moment, if they say that, and you have to buy back the share, you are screwed. Basically, the patience of your own investors matters over here when you are short selling it. Now, noise trader risk is like this. Noise trader risk is a limit on arbitrage whenever arbitragers have short horizons. Okay, and you may have to close a good trade at a loss, and you have this kind of situation in the Big Short movie there as well. Okay, if a limited capital to meet the margin calls, then you are screwed. Or if you are a hedge fund manager with investors who don't understand that your trade will eventually make money. Unfortunate. This kind of situation of mispricing or noise trader risk was also documented at the 3Com and Palm computer case, right? ThreeCom is the one that invented the Ethernet or landline, LAN, landline, right? You see in your computer, right? And your wall. And that's the telecom equipment company and router company, ThreeCom. And they had a division that invented a Palm Pilot computer like this, PDA, Personal Digital Assistant. If you remember this, you're at it together with me. Welcome, man. And then high five. Yeah. So at one point, this is a parent company, that's an affiliate company. They split off, right? Spun off, and then did the IPO, hoping that, you know, this company's market cap, whatever it may be estimated, the proportionate ownership value that this company has will be going high together with it, so that this company's value will be bigger than that. But the similar situation happened for this Palm computer and ThreeCom. The parent company ThreeCom shareholders received 1.525 shares of the affiliate company that did the IPO, the Palm. If the Palm price was 100 and the parent company's stock price has to be bigger than 152.5, that means, right? But what was the reality? The first day of IPO, Palm's price jumped up to $95 per share. Now multiply this guy by 1.525. That must be bigger than $100 anyway, right? But ThreeCom's actual price was only $81.81, which means severe mispricing. Right? So this kind of noise trader risk is very, significant stumbling block in doing the short selling. Now you have the Big Short movie to watch, right? Go ahead and see it, and you're going to enjoy that a lot. And then the next thing I'm going to talk about, the next video, we're going to talk about the individual investors short selling. So wait for that. Thanks for watching.